Now, let me introduce you our speaker today. His name is Stephen Kwong. Stephen is the Senior Vice President of Futures Broking in M Investment Bank. He serves in the leadership role in the company and is responsible for the business development, operation, and sales in the futures broking division. He is a veteran in the industry for over 25 years of experience in Malaysia listed derivatives and securities industry. So without further ado, let me pass the presentation to Stephen. So Stephen, the stage is yours.
Okay. Today we are talking about what every trader or investor must know about margin call. Firstly, as usual, I need to put this disclaimer up. This presentation is provided for general info only. It is intended as an investment advice, offer or solicitation for the purchase or sale of securities, stocks, futures, or investment products. Stocks, futures, and securities imply risk, so it can be undertaken only if you understand its risk. Please seek your own tax, legal, financial advice before investing in stocks and futures. All the information in this presentation is subject to change without notice. Okay, got rid of the compliance bit. Now, there are a few items that I want to cover. For the outline is what is margin futures, common types of initial margins, types of errors in trading, and how you can avoid them. What happens when there's a margin call, how to manage and avoid margin calls, and then the importance of it from a broker's perspective. Finally, complications of a deliverable contracts. All this sounds a little bit like technical. However, just to throw in a little bit of a candy here, there will be a slide in the middle somewhere whereby I will actually give you a tip on how, where there is a very sure win situation which you guys should look for when you're trading. So I'll get to that when I come to that slide. Firstly, a bit about futures market is, as you probably will know, is highly regulated by Bursa Malaysia. Okay, in futures trading, unlike stocks, you can trade both up and down directions. That means, unlike the stock market, when the market is coming down, you can't really make money from it unless you already own the shares. On futures, if you think the market is coming down or in a bearish trend, you can actually sell first and buy later at a lower price and make money from there. Liquidity is quite high. Trading cost is a lot cheaper trading in futures compared to stocks. And then you will be able to diversify. Instead of just trading stocks, you can look at other asset class as well. And then you can hedge on your portfolios, on your stock portfolio if you want to as well. The main point about futures is basically leverage. You don't have to come up with a huge capital outlay. Margin is the only one, it's the only thing that you require. That's why I will concentrate only on margin that's required in today's session. And then for trading stocks, you have like more than 1,000 stocks now in Bursa Malaysia to pick from. For futures, it's a lot easier. You generally trade on two of their most Bursa's most successful products, which is the index KLCI and crude palm oil. Okay, let's go on to it. What is margin? A little bit about information about margin first. Now, Bursa Malaysia is the guarantor for every contract traded. Whether you're buying or selling, Bursa is the guarantor. Then, to ensure that they can guarantee or play the part of guarantor, they will make sure that initial margin is placed by whether you're a buyer or seller. Okay, so whether you're a buyer or seller, you will receive the due profits when the trade is done because Bursa Malaysia is the guarantor. Now, in order to perform this role as a guarantor, Bursa Malaysia Derivatives collects what we call initial margin as performance bond from each participant. Yeah. Now, to be the guarantor, Bursa Malaysia uses the international formula called spend margining system that calculates historical data to determine the amount of initial margin to be collected in order for Bursa to be guaranteed of all trades. Now, just to summarize it, so they will look at the volatility and take the data of this product for the last at least 10 years, so that they can calculate how volatile the product is. And then from there, they can determine that within a day or 2 days trading, what kind of margin they need to be able to collect to make sure that they are able to play this guarantee role, right? I'm not going to go into the formula because it's going to be too complicated, and that's not something which you want to get into, all right? So during adverse intraday price movements, all right, Bursa may raise initial margin requirements, right? But this hardly ever happens for so many years that I've been in the business. Bursa seldom initiates any changes in initial margin requirement. However, it's quite common that during long holiday breaks, Bursa will raise the initial margin required, because when it's a holiday in Malaysia, and let's say some fundamental news is happening in the US or China, or for example, like Russian war or something like that breaks out during our holiday break, it will mean that the market will be volatile and other markets are open and it's still trading. However, Bursa, because of the holiday break, there's no movement. However, can you imagine, once the holiday break is over, then it'll be very, very volatile. That's why usually Bursa, prior to a long holiday break, they will review the situation and usually raise the initial margin requirement. But usually they don't do it also on the last minute. They will actually inform all the brokers that, let's say Friday is a holiday that begins. They will take 3-4 days. So probably Monday or Tuesday before the holiday starts, they will say that initial margin has been increased and this will be the new level. So it'll give everybody some time to readjust their position, or top up their deposits, just to make sure that you'll be able to hold their positions. Okay. So, and as far as Bursa is concerned, since they're playing the role as guarantor, it is common that if the product price movement is very volatile, then it is more likely to safeguard themselves. Bursa will make sure that the initial margin required is going to be higher. Okay. Example, if you guys understand the two products that Bursa usually have now, which is the KLCI, which is the composite stock index, that particular product is not very volatile. So at the current moment, the initial margin required for FKLI, the index futures contract, is only 4,200. But if you compare this with the crude palm oil product, which is a lot more volatile, that particular product, FCPO, requires 11,000 initial deposit per contract. So it's all about volatility here. For your information, for those of you who do not know anything about these two contracts, FKLI nowadays can move around 10 to 20 points within a day. All right. And if you know about the movement per tick, 10 to 20 point movement is about 500 to 1,000 ringgit in terms of the contract tick size. So for FCPO, nowadays CPO can move easily between 100 to 300 points. And in monetary terms, that could be between 2,500 to 7,500 ringgit within a day. So the volatility will actually dictate the initial margin requirement. Okay, let's take a step away, and I want to explain on the kind of initial margin requirements. Basically, there are two types. One whereby there is an outright position, and another one whereby we call it a spread position. Okay, I'll just take some time to understand a bit about these two types of positions. Now, an outright position is whereby you are either pure long, which means you are a buyer and you think you're bullish and the market is, to your understanding, supposed to be moving upwards, or you're a pure shortist or a bearish position whereby you think that the market is coming down. So you either one of these, as far as an outright position is. You think the market is going up, you buy. You think the market is coming down, you sell. And these kind of positions are riskier because you are exposed to higher losses if the direction is wrong or is against the position. Okay. Currently for FCPO, I mentioned just now, the required margin is actually 11,000 ringgit. So Going in through the contract specifications, 11,000 ringgit actually equates to about 440 points for the crude palm oil contract. All those are just for information only, nothing really important so far. Spread position, I'm going to explain a little bit about this here. This is basically a position whereby you are both long and short in one product, but your position is different in terms of timing. That's what we call it, what generally people understand is to be a time spread position. So you take such a position if you think that there is too big a discrepancy between the months within the same product. Don't get too confused. I will show you actually a chart, and then you will have a better understanding of it. No, so basically, in a spread position, you can actually buy, let's say for the month of May, and then you sell in the month of June, because that you perceive that the May prices is too low compared to June prices. Just keep this all in perspective. I will show you in a chart later on, and then you will have a better understanding, right? Now, because of the opposite position, that one is a buy and one is a sell, basically the initial margin required for such a position is much lower. Remember just now I said FCPO outright position is the initial margin required is 11,000. Well, for a spread FCPO position, the initial margin requirement is 2,700. So it's a lot lower because the risk is much less. When one position is making money, usually the other position is losing, and it's just a relative comparison, that's all, right? Now, I know some of you might be confused, but I will actually show you this chart here. Yeah, this will help you understand it a little bit better. All right. The blue line is actually the July CPO contract. The orange line is actually the August CPO contract. That's the price that's traded for those two contracts. Generally, the July contract trades above the August contracts. Generally, this is because of a contango effect. Again, I'm not going to go into the terminology. If you go back as far as like 10, 15, 20 years, the nearer month will trade higher than the further month. So basically, if you are trading, what are we now? We are in June, all right? June basically will trade higher than September contracts or October contracts, the further months one, okay? Now, I just want to show you this, and this is one of the tips that I'm going to tell you how to make money here, and it's quite a certainty here. If you see, generally, if you are looking at what are we now, August 20th, everybody can see my cursor, right? Around August 20th, a month later, towards the end of September. So this is a 1 month period. Generally, the blue line is most of the time above the orange line, okay? Trading opportunity comes when it's either very close together or actually it touches, okay? So I can tell you a few points. There should be at least 7 to 10 opportunities here. Here, you see, for around the 20th of August, there's an opportunity here. You see the price of July came down quite steeply and is quite close to August. There is one opportunity here. And then here, when it actually touches August, there's another opportunity here, okay? And here, you see actually crosses over. There's an opportunity here. Bear in mind, just believe this based on historical. Generally, July or the near month will trade above the far month. So blue actually will trade above. So you got 1, 2, 3, where actually crosses. Here again could be 4, and then you can have 5, 6 opportunities here, 7, maybe here as well, 8, and then 9 around here. Okay, there's at least around 10 opportunities. Now, how do I mean about opportunities here? So generally, take it for me that July will be above August. and usually it will at the end of normality. So because in this case here, July is trading quite close to August, so what you can do is actually, because you believe that July should be above or trading well above August, you actually buy July and you sell August. When you buy, you want it to go up. When you sell, you want it to come down, correct? So imagine you bought July, the blue line here, and then you sell August, the orange line here. And if you believe that it's supposed to be at a premium, let's say here, so when you bought July, it has gone up to here, you can sell, it's gone up this much, correct or not? And if you have sold, you want it to come down. But in this case, it didn't come down. However, it didn't go up so much. So your profit level is from this point to this point. And your loss level is that it's gone from here up to here. So you have a difference of so much that you have made profit on. Am I clear here? All right. I show you another example. If you believe that always the near months is trading above, here's another opportunity. Because it came down, you actually buy July. And at the same time, because it's a spread, we call it a spread trade, you sell August. So if you believe this is the point where you need to get out, you bought here and you sold here, it's gone up and you made a profit of this level. And for your August, when you sold, you might not have made much or you have made a little bit, but it's still that kind of difference here that you've made. You get what I'm getting at? All right. I show you another position here. It could be here as well. You bought the blue line. It actually came down. And then you sold the orange line. It actually went up. But it's only momentarily. You see, if you had taken the position here, you bought blue line, you sold orange line. Imagine that once it come up to this level, you hold the position. Your blue line, you've actually made up this amount. Your orange line, you have lost, but you lost less at this amount. Okay, one will make, but the amount that you make will be much more than the one that you lost on the other bit. Okay, here is the same thing. Here, you bought the blue line, you sold the orange line. So imagine you held your position at this time zone. You bought the blue line, it has gone up, so you have made a little bit of profit here. But you sold the orange line, which you want it to come down, and it's come down so much. This is another level of profit that you've made. You guys get me? I'm not saying that you generally will always make the biggest level, but you pick lah. Generally, it can be this level as well. Okay, it can be this time zone. It generally will make sure that the ones that's making will outstrip the one that you've lost. Okay. You guys can do your own homework. You can find, I'm just giving you this example, which is July again, August. You can, if you got a chance to go to your broker, or if you guys got access to price feeds or whatever, you can go to Bursa's historical price feed and you look at the months that's traded. Most importantly, it must be the same product, which is crude palm oil, and the underlying is the same. It's just that different months only. Then you will see that generally the near month is trading above the far month, and they are occasionally when they sort of like meet together or come close to meet together, and then when they normalize and go further apart, that's when you can unwind your position and make it. Okay, you see, generally, if you look at this particular point, this is generally the normality, whereby the blue is above the orange. You see, just that sometimes it gets closer together and sometimes it's further together. But I wouldn't advise on just on closer. Try to catch it when it's sort of like crosses, and then you have a better chance of making more money confidently. Okay, so I hope you catch what I mean here, and then you can enjoy your trading more here. Like I said here, generally if you look at the trend, when it comes down, both of them will come down, and when it goes up, both of them will go up. Okay, so it's similar directions, but the extent or degree of each movement may not be the same. Okay, so the risk is less as well, and like I say, the charts above shows that there's at least 7 to 9 opportunities within a month. Okay. The other thing is that, remember, when you're trading outright, you need bigger initial margin, as I mentioned just now, 11,000 ringgit. But if you're trading spread, you only need 2,700. So when you're trading this kind of spread strategy, you actually have less capital outlay compared to the riskier outright position that you have to trade. The only thing here, what I'm trying to say is that if you look at my example here, within a month, you've got 7 to 9 opportunities. So for this is more like for a patience trader. So for those who don't have the patience, then you're always wanting to go into the market, spread trading might not be your cup of tea. Okay, right, let's go now next to a few things that I want to cover as well. Type of errors and how you can avoid them. Okay, now in more than 20 years I've been in this business, I can safely say that getting your trades correct actually is the easy part. It's only 50-50. You either go long or you go short. So, you can get it correct on a 50-50 basis. The actual difficult part is after you've done the trade and what do you do. Now, most traders use either fundamentals or technical support, technical analysis to support your view on the market, correct? So if the fundamental says that the market is going up or technical is saying that the market is going up, you just buy. And if vice versa, if those news are bad, then you just sell. So when you have all this support and you go into your view, then what you do later is expect more of the movement. So for example, you think the market is going to go up, you buy. And then you think that the fundamentals are going to kick in more and the movement is going to go more up. And then you sell only when you think that, it has gone higher than what you expect it to be, right? The other scenarios is part B here. It could be the market has overreacted. And this is due to an effect of what we call a margin squeeze. I will define this much more in the later slide. So basically, in trading wise, there's only two scenarios. Firstly, you expect the market to move, and it does move, and then it goes higher or it goes lower in the movement that you expect it to be. Or you can trade against it, as in like you think the market has gone up or it has gone up far too much already. Instead of going long, I think the market is overreacted. I will go short because I think it's an overreaction, or it could be a margin squeeze, and you trade based on that. So those are the two expectations, and that's normal trading. All right. The difficult part is this part 3 here, the scenarios which a lot of novice traders don't know what to do. All right. You think the market is going to go up, or the fundamentals shows it, the technicals all show it. But then as you took the position, suddenly more fundamental or rumors come in. So what do you do? Or suddenly there's a lot of fundamentals or rumors that go against your view. What do you do? Like I say again, from the first point, getting the trade correct is the easy part. It's just that halfway through your trade or your plan, suddenly it goes wrong. This is where you differentiate between the boys and the men when it comes to trading. You have to know what to do when things don't go right, and that's how a good trader survives. Okay, so I want to bring to your attention to this part 3 here. All right, you have to, when there's no news, or when there's fundamentals or rumors going against your view, you have to choose either one of these two. You should have a trailing stop, or you should at least maintain your P&L ratio. Okay, let's go back to the second point first. When I say P&L ratio, most of you might think that when I do a trade, if I lose, I can afford to lose 1,000 ringgit. But if I want to make profit, I prefer that it goes up to 3,000. So based on this ratio, there's a 3-to-1 loss ratio, P&L ratio. You understand what I mean? So every one of you, when you start trading, you must have a P&L ratio. That is good discipline trading. Okay, so assume that you have a 3-and-1 ratio. Now, when you start taking a position, okay, and then difficult scenarios come in, right? You should have trailing stops that relates to your P&L ratio. Now, let's put some numbers in. The market is at 1,000 level, all right? And you think the market is going to go up 50 points, okay? If it goes to 50 points, you will take profit. If it goes against you 20 points, you will cut your losses. So you have a 5-to-2 ratio, correct? Now, let's say it goes up to 50 points, and then suddenly more news comes in, and then it's going up some more. You can still keep your P&L ratio 5-to-2 moving up, okay? But you must have a trading stop. That means, like I say, if it gone up 50 points, it go up to 60 points, it go to 70 points, you're still having your profit run. However, from 70 points, once it goes down to 20 points, because you have a 5-to-2 ratio, it goes down to 20 points, you should have profit-taking positions already. So you will still have your P&L working for you, rather than not having any kind of plan at all. You might want to read up on it, or you can go Google and find out what trailing stop means. So basically, if you have a ratio 5-to-2 or even 3-to-1, if it goes up to 3 points that you made money, it continue to go 4, 5, you can hold on to it and keep your position. But because once it goes 1 point above from your highest level, so from 6 already, it goes down to 5, then you start taking a profit, you are still having a plan. And this is what we call trailing stops, okay? And then, like I say again, you're always maintaining your P&L ratio. This is all about discipline trading. Right, these are the things that you should avoid. You must have stop loss. You can't just go into a trade and then, not knowing what are the damage that you're able to face. You must be disciplined and says like, if it goes right, I'm going to make so much money. But for some reason, it goes against me, I am not going to take more than this kind of losses. You must have a figure here, right? Knowing when to get out of the market is important. So you must have a level before you actually get in. Understand? Now, anticipate for the worst. Always, always. It's easy that you get it right. It's also easy that you're riding on your profits. But always expect that what if it goes wrong? What am I supposed to do? You must have a plan and stick to it. Do not try to move your positions. Trade within your means. Again, identify your risk tolerance level. Okay, don't try to, like we say, borrow money or trade way above your means here. This is not advisable. Just make sure that you have a good buffer in terms of the kind of financing that you're able to provide, and then you must stick to it. Okay. Now, I want to go a bit into what happens when there's a margin call. So if you should understand what it means. Firstly, what is a margin call? And if you look at the blue bar here, I give you the example. Bursa is the guarantor, and they use the spend margining system, and they calculate that initial margin required for one contract is 11,000 ringgit. So when your equity balance, and this equity balance takes into account your unrealized P&L as well. So if you had initiate a position and it's making money, and your equity balance, that means it includes your P&L, is above this 11,000, let's say it's 20,000, there's no margin call, right? As far as Bursa is concerned, or as far as the broker is concerned, there's no margin call. Okay, here, if the initial margin requires 11 and you're actually having a, let's say 1,000 ringgit unrealized losses, so your balance is actually 10,000 because you have an unrealized losses here. That is where it will be triggered a margin call, and the broker will require you to top up. This is what happens when a margin call is done. The broker will check your equity balance against the last traded price. It is always against the last traded price in the market, right? If you don't have enough, the broker will contact you, inform you of a shortage, and then you have to respond. Either you pay or you close your position. And when you pay, you must provide proof of transfer. Okay, any non-responsive action by the client, it will deem to be a failure to meet your margin, and then you'll be forced liquidated by your broker, and then most probably they will suspend your account because they don't want any double position. Because if they don't suspend you and you did not know that your broker has forced liquidated your position, you could actually face two positions on the same account. Now, what do you do? How do you manage your margin call? First of all, when it's a margin call, you have to decide whether you want to hold your position. Okay, if you believe, or if you are not disciplined enough and you think that it's just a jerk reaction, you top up the process and maintaining your equity balance above the initial margin required. So remember, when the trading hours is still open, the equity balance is still moving. Okay, and if you decide to cut your losses, just cut it yourself. Don't let your broker force liquidate you, because like I say again, once the broker force liquidate, they will also suspend your account. That means you won't be able to access the market. Okay, now earlier on, remember I spoke something about margin squeeze. Now basically, from a broker's perspective, when the market is going against a few clients, all right, so there could be a domino effect here. So when I'm closing out client A, that means force liquidating it, that could actually present a domino effect whereby client A will actually trigger client B's position as well, and client B will actually affect client C's position, and all going to be a domino effect. So when this happens, right, the market price is traded out from all these stop losses, and this is what we call a knee-jerk reaction, and this is what we call margin squeeze. So this overreaction is where I mentioned earlier on, some people can trade because they think that, the margin squeeze caused the prices to overreact, and you can trade against it and let it normalize again and then take profit from there. Few important things that you must know and you must avoid. Very, very serious here. Remember I said there's outright position. So when you think the market is going up, you're going to buy and you go long. Then margin call come in. And like I said, margin call, let's say for FCPO is 11,000 ringgit. And then the P&L losses here means that your equity has gone down from 11 to 10,000, right? So what the client can do is that they go and lock the position by initiating a spread position. Remember, spread is when you go long on one side and short the other. And when you have a spread position, the margin requirement is a lot less. Like, let me reiterate. Outright position, margin requirement is 11,000 ringgit. On the spread position, margin requires only 2,700. So when you're wrong, you go and lock it by initiating a spread position, by going opposite in another month. Yes, you stop margin call, but at the end of the day, you will be too confused with your position. You won't know what to do, and that will be it will create a lot of chaos as far as your decision making is concerned. So do not try to lock your position. If you're wrong, just get out. Over leverage, again, just don't try to take too big positions, right? Make sure you have sufficient buffer for every contract that you trade. Do not trade with fear money, all right? Sometimes you just, at the end of the day, to summarize it, you just can't afford to lose. That's why it's not advisable to trade fear money. Always have enough buffer to make sure that you trade comfortably within your own zone. Some of us will always use the word survive to fight another day. Okay. Do not let your losses continue to run. Always have a plan and make sure you have stop losses when you initiate a position. Some of the things that you should be looking out for, good practice, opposite to what are the don'ts that you shouldn't be doing. Have sufficient money in trading account, all right? Always be prepared, have a plan. When you go in, you will know that you have a P&L ratio, what level to take profit, what level to take losses initiate stop losses, and then you will feel more calm when you're trading that way. Okay, be disciplined, cut your losses early. Don't try to run in and say, maybe I'll give it a few more hours, maybe I'll give it another 1-2 days. Just be disciplined. Okay, manage your risk by sticking to your P&L ratio. Always have a good P&L ratio. Now, when I say a good one, it could be 3-1, 5-2, or even, worst case 3-2. Don't have those that, I'll take a 1,000-point gains against a 10-point losses. That kind of ratio is just meaningless. There's no point going to that. Trade to the size of your account. Okay, don't over leverage yourself. Now, the importance of margin from a broker's perspective. I started off by saying that Bursa is the guarantor and they determine the initial margin requirement, correct? Now, Bursa will then dictate with the broker to say that, for every one of your client who initiates a position, this is the initial margin required. And Bursa will expect the broker to collect from the client and then at the end of the day, deposit it to Bursa as a guarantor. This is how the process works. Now, when Bursa relates to the broker and says that you've got clients who are long 100 lots, and then you times that with the number of initial margin required, the broker is obligated to pay. Now, if the broker fails to pay, then they could be and they will be suspended by the regulator, Bursa, and all their clients' position will be void. So no broker will allow that to happen. That's why the brokers themselves, when they don't get the margin call payment from you, they will force liquidate it and they will not allow Bursa to suspend their license. Okay. Okay, part 3 is quite obvious. Now, again, each open position is marked to market on a live basis. So unlike the stock market, futures position is based on mark to market on a live basis and the prices are moving all the time. They don't wait until the end of the day. So all margin calls are based on the last traded price to be calculated and to make sure that it's above the required initial margin for each account. Again, brokers will not allow the client. Okay, most clients will have cash upfront policies initiated by the broker. So you must have money upfront in the account before you're allowed to trade futures. And no brokers will allow you to go to negative for that account. That's why when it's close to zero, the brokers will force liquidate your positions. Okay, this is for your information. Conditions of a deliverable contract. Now, this is for your information. Now, Malaysian palm oil bond, all right, requires you to have a license to handle physical crude palm oil. The seller will put the palm oil in a storage tank in one of the designated ports, and the quality of the palm oil must meet Bursa's minimum specifications. I'm going to go through this very quickly. The buyer pays the full amount because, like I said, futures is a leverage product. So the buyer, on expiry of a deliverable contract, will pay the full amount, and then Bursa will then collect the receipt from the seller and forward it to the buyer. Upon producing receipt, port authorities will allow the buyer to go and collect the oil. To summarize it, the above explains why brokers do not allow ordinary clients to hold open position on spot month contract. So basically, when you're trading FCPO and it's a deliverable contract, there is a chance that when the contract expires, you will be what we call taking delivery of the product. That means 25 metric tons of crude palm oil. And you need to be licensed and you need to know the kind of minimum specifications of the palm oil. Basically, a novice or a retail client will not allow to hold position for a spot month contract. So be aware of this. So most probably the broker that you are engaged with will not allow you to hold positions for spot month contract because it's just too complicated. Now, we are coming towards the end of this presentation. three key takeaway points here. Always remember, as guarantor, Bursa collects initial margin from all sides to ensure that the positions are sufficiently covered. So it doesn't matter whether if your position is making money, you are still required to put up initial margin. All right. Margin calls are the most common determination of traders' position. For futures trading, it is very imperative for you to understand margin call, and they are this particular parameter actually determines whether traders' position are closed out early or they can hold the positions longer than expected. So understanding margin call is very, very important. Lastly, all beginners, novice traders are only prepared for the expected outcome. So when something happens and they're surprised, most of them do not know how to react. So I hope some of the slides that I've already presented and some of the points that I put out will help you understand that, you know, how to face those scenarios and what are the steps that you need to take up. Okay. Any questions